Thank you for joining Market News with Rodney Lake. This is a regular program for the GW Investment Institute, where we talk about timely market topics. I'm Rodney Lake, the director of the GW Investment Institute. Let's get started. Welcome back to Market News with Rodney Lake. I'm your host, Rodney Lake. All right, we're into season 3, coming to you from the GW School of Business, George Washington University School of Business, right here in Duquesne Hall in the Duquesne Family Studio. All right, this is a GW Investment Institute production. Thank you very much. And as you know, if you've been following the show, and welcome back if you're coming back, and welcome if you're listening in for the first time on the podcast or YouTube, welcome to the show. So today, we're going to talk about a company. This is a company in our portfolio, GW Investment Institute Student Investment Fund portfolios, and the company is Meta. As a reminder, disclaimer, this is not investment advice, educational, and entertainment purposes only. All right, so the company is Meta. I'm sure you have all heard of it. It used to be called Facebook, and one of the platforms is still called Facebook, but they changed their name to Meta, and that's what we're going to be talking about today. So what's on tap? All right, so we're going to use the GW Investment Institute framework, business, management, price, valuation, and balance sheet. You can check our blogs to talk about that, but it's super important to have a framework when you're an investor and you're an analyst to tackle things. So we do the fundamental analysis work at the GW Investment Institute. Our students do that work, and we ask them to do that hard work, and they do a great job, and they've been doing a great job over time for that. So, all right, we're going to be diving in to each of those segments, and we're going to talk about each one of those segments on the show here. So what does that mean for all of us here? All right, so one of the things that as an analyst, you got to really think through, and you got to think about, like, how are you going to tackle each one of those segments? So we're going to break down each. We're going to spend some time on each, and we're going to score each. So we score 1 through 10 if you haven't paid attention before, 10 being the best. We weight them each 25%, and we have a composite score at the end. Our students do this throughout the semester. They work on these companies, they work on these ideas, and they do their stock pitches at the end of the semester. All right, so Meta, the ticker is META. Meta, again, used to be called Facebook. I'm sure most people know this company and use this company in some way. So what do they have? All right, so there's this family of apps, as they call it here. This includes Facebook, Instagram, WhatsApp, and Messenger. Most people probably know Facebook or use Instagram or use WhatsApp or use Messenger and use one of these things throughout the day. So they have over 3 billion daily active users on the platform. So obviously somebody's using this. That's a huge chunk of the entire globe. And so it is important to think about, okay, well, their total addressable market seems to be not much more, but they're certainly a very profitable business. And so what do? It's really, they make their money from advertising. And so if we think about, okay, well, how does this company make money? When we talk about, okay, well, what does this company do? Where does the revenue come from? Well, the revenue really comes from advertising from this family of apps. And so advertising, and a huge chunk of that's coming from Facebook directly, to a lesser extent, Instagram, Messenger, and now more recently talking about how are they going to monetize the messaging system. And so that has come with some maybe controversies too strong, but certainly, how are you going to monetize WhatsApp? All right, so breaking down, let's get into the business. So we're going to go business, management, price, valuation, and balance sheet. So let's talk about the business. What's the market capitalization of this company? Number one, $1.8 trillion. So this is not a small company. This is in the Mag 7, and we've talked a little bit about the Mag 7 on one of the episodes. So $1.8 trillion. So a large company, one of the largest in the world, and it has been for a large company for quite a while now. Advertising drives this business, and they've been good at doing that. And so if you look at, okay, what we tell analysts, and if you've been following the show, look at it over time. What's happening over the years? So if you look at the trailing 12 months, the market cap, or snapshot in time today, 1.8 trillion. And if you look at that over time in 21, that was 921 billion, and then down. So there's a huge sell-off, obviously, at that point, down to 314 billion. Obviously, a big buying opportunity if you were there. Then back up to almost $1 trillion, and then 1.4, and now 1.8. And so there was certainly a tough period where people were very skeptical about the metaverse and the reality labs. That's the other part of they're getting a little bit of revenue from that, but really everything's is going from advertising. And we'll talk a little bit about AI. So they have the llama models. And so the llama models are these open weight models, not fully open source, but open weight. And they can still control the commercialization of how you might use that model. So it's certainly a different tack than what OpenAI is doing, a different tack than what Microsoft is doing, a different tack than what Google is doing, and Grok at XAI. But it is, they are trying to find their space. And it is interesting, and I think it's worth watching. So as an analyst, as a business person, as an investor, I think it's important to pay attention to, obviously, AI in general. We've been talking about many companies. Important to watch, okay, well, what are these different companies doing? So Llama is what they're focused on, and is an open weight model. It doesn't mean completely open source, and they still control how you're going to commercialize this, what they have out there. So it is something possibly in between fully open source and fully closed source. And so this open weight model, you can see the parameters, you can see the weights, and you can use it. But they still have, say in how that gets commercialized and how you use it. So I think, people may be reluctant to build on it because of some of those reasons. And so some people are, again, obviously taking different approaches. Google is taking a different approach with Gemini. It's not an open weight model. It's not an open source model. It is completely closed. All right. So back to the business of Meta on the number side. So what are they generating in revenue? They're generating a lot of revenue, 170 billion in revenue, trailing 12 months through March 31. That's a big number. Again, virtually all from advertising, and a huge chunk of that coming from Facebook. And they've really been good about analytics. They've really been good about, how do you, if you're buying advertising, is it working, right? And that was the criticism of advertising for many years. It works 50% of the time. You just don't know where, is one of the sayings in the advertising world, or something to that effect. The analytics are much better. Obviously, when you're on this platform, the type of users you're going to have, the conversion rates and all that, you know it. And so it doesn't mean it's going to work all the time, but you're certainly going to know if it is working or it's not working, and the analytics around that. And so let's look at the revenue. Again, we say, okay, well, let's look at this over time and where do we think this is going? Revenue, 117 billion in 21, 116 billion in 22. 134 billion in 23, and you really had a big growth number in 21, 37, and then you had a downtick, 117 to 116, minus 1% there, then back up 15%, 134, and then another almost 22% to 164 and 24 for the full year, and then the trailing 12 months now up 20% year over year, about 19.4%, 170 billion. Projected full year number almost 188, 14%, and then 13% to 212 in 2026. And so you can see that revenue dipped, came back up, and now it seems to be, flattening out to declining, right? The projection is actually it declines from a high of here of, let's say, 21, almost 22 for 24, going down to 19 or right now for the trailing 12 months, and projected for the full year 25 to go to 14 and 13 for 26. And so something we have to watch out for. Okay, the revenue is possibly is peaked. Where are they going? AI is a huge part of that. They're spending a lot of money on AI. So if you follow these companies, Meta is one of the ones who's spending tens of billions of dollars. They just talked about building more data centers, 5 gigawatts as an example. That's, a huge, a lot of homes equivalent for a data center, and the power, and obviously the grid is super important to consider when you start scaling up this large, and the amount of power that these data centers need to do the compute. So as an analyst, business person, investor, you need to think about what Meta is doing. Think about this allocation of capital. Our analysts have thought about this. This is a meaningful position in our portfolios, by the way. So it's not a tiny position. It is a meaningful position in the portfolio. So it's consequential, and we certainly need to watch it, and our analysts need to pay attention to it. What do I think about what's happening on this? I think it's important to really pay attention to this pivot from what was the metaverse and this reality labs and the money that they're spending on the AI. I think that's super important. I think you got to pay close attention to what's happening there. I think, as an investor and as an analyst, as a business person, that allocation of capital is supremely important, right? That's how Buffett, became legendary as an investors because that allocation of capital was so fantastic, was so elegant in the way he did it. Now, as a CEO, you're an investor in your company, right? You're allocating those retained earnings. Where is that money going? And so, where's this money going? You had the big sell-off, and you certainly had concern when they're plowing money into the metaverse, and they changed their name. Now they're plowing money into AI. I think that's much more fruitful area. It seems to be going in the right direction. But paying close attention, they are big numbers. But when the opportunity is big, you got to bet big, and you have to invest heavily. And so I think they're absolutely on the right track as far as seeing, what is the opportunity. Now, none of us exactly know where the opportunity goes and how people monetize that, but they are in the game. They're certainly poaching talent. So if you read the news, they're poaching talent from OpenAI, Google, and other places, and they're paying these huge pay packages, kind of like sports packages. And so $100 million for a contract, numbers that that typically only CEOs in a company get. These people that have these skills in AI are getting paid that, right? Certain set of skills. They're getting paid those numbers, again, almost like big sports contracts. And so good for them for having that talent and being at the right place in the right time and monetizing their skill set. And hopefully that translates to value for shareholders. Obviously, as an investor, that's we care about. Certainly, we're cheering them on for doing a good job for themselves. But as owners of the company, we have to say, well, we hope that this is going to work out. Individually, we're rooting for them, but as an investor, do we think that this is going to pay off? Do we think that it's going to be useful to pay that high number to get that talent? Now, when you're talking about big numbers like Meta, maybe these things, 100 million over 5 years is not going to necessarily matter. I don't know the terms of each of these contracts. Maybe it doesn't necessarily matter, and maybe having this talent, at this certain place at this time is going to make all the difference in the world. People make the difference, period. All right, so back into the business here. Revenue in good shape, but flattening out to declining. What are the gross margins? Again, revenue minus cost of goods sold, 81%. These are exceptional, right? When you're in the 70s and 80s, these are the numbers. We went over ServiceNow on the prior episode. We've done NVIDIA, Visa. These are top tier gross margins, right? And so when you think about, okay, well, how can it be so high? We are selling advertising online. Obviously, you can have high gross margins. So, but is it a one-off? No, it has not been. You're talking basically 80% for the last 5 years. And so gross margins are good and slightly improving, actually. And so they're 81, almost 82 of the trailing 12 months, projected at 80 and 80. So really consistent there on the gross margin side. And then we drop down to the net margins. Also fantastic. You're talking 39% gross margins, projected to go up. And so net margins, this whole efficiency push that Mark Zuckerberg will talk about management here in a moment, 40 now plus in 25 for the full year projected, and 41 for the 26 projected. And if you look back, it's basically 39 for the trailing 12 months in March 31. And if you go back, it's increased. And so the net margins in 21, 33%, 25%. They had a drop in 22. The efficiency push here, 33, 38, respectively in 23 and 24. And again, trailing 12 months, 39. Again, moving in the right direction, 43 plus in 25 for the full year expected, and 41 plus in 2026. So that all looks good. Free cash flow generating $52 billion in the trailing 12 months, full year 24, $54 billion. So a lot of free cash flow. And if you look at, again, over time, the 2021, $38 billion, almost 39, and then it dropped $19 billion and then $43 billion. They're plowing CapEx in. So if you look at what's happening on the CapEx side, 21, almost $19 billion, $31 billion in 22, $27 billion in 23, 24, $37 billion, trailing 12 months, 43, and expected $67 billion, going to 67 to be clear for the full year 25, projected 26, $78 billion, right? That's a lot to do with the AI build out. Pay close attention to what's happening there. These are big numbers, big opportunity. What's going to happen? Who wants to lose the AI game? The answer is nobody. Certainly not the big players. They're there to win, and they are putting their money where the mouth is, and they're going after that opportunity. And you're talking about $67 billion in CapEx for the full year. It's a really important number to watch, and what's going to happen with that, and what's the payoff from that. And 78, almost 80 billion estimated in 2026. These are big numbers. these companies are playing to win the AI game. All right, moving on. So what do we give the business before we move on? The business is excellent, right? When you look at the numbers, we talk about, okay, well, pull away. Don't even think about what it is. What do the numbers look like? Well, it's an advertising. Advertising is good business. But if you don't think about that, the numbers are stellar. 80% gross margins, 40% net margins, generating a ton of free cash flow. We like all those things. Then it's advertising, it's online. They're trying to figure out AI. Okay, makes it probably the story even better. All right, so business right now, 8.5, 9 for the business. We can give it. All right, moving on. Next is management. Well-known, Mark Zuckerberg has run this company since inception. One of the criticisms is that he controls maybe 14% of the shares, but because of the voting of the economics, it's a very different setup. So when you think about, okay, what's the voting of this? It's a 10-1, so he controls something like 80% or something close to that, 70 plus or something for the voting. That's a big difference, and certainly certain people get excited about that and get concerned about, okay, well, this person is going to continue to control the company. Let's say it's way more than 50%. They're going to continue to control the company, control the board, right? So that's important. So if you're an investor, you're along for the ride effectively for this because of this super class share when you talk about a 10-1 ratio for this. And so the voting is disproportionately controlled by him versus the shareholders in the A-class shares. The B-class shares 10-1. If you're okay with that, lots of people have been okay with that and have made money doing that. But as an investor, it's just something you need to pay attention to. There is this dual class of shares that you have to pay attention to as an investor. Zuckerberg controls 10-1. And so that's going to be really important from the economics to the voting power. And so it's going to be really important as an investor. You got to know that, number one. And number two, decide if you're okay with that or if you're not, right? If you're not okay with that, if you think that that's such a large corporate governance issue, maybe you avoid Facebook, if not, or Meta in this case. Maybe not. Maybe it's not. Maybe you think, well, I don't think it's such a problem. Maybe I'll take a look at the other board members. I think certainly if you do have concerns and it's maybe, sometimes that's a no. But if you're like, hey, I want to do some more due diligence, how else can I do this? Well, look at what's been happening on the board. Obviously, he controls that. But it's important who else is on there. Do you think these are sensible people? Do you think he's getting good advice? Ultimately, he will make these decisions and he will control the board. And the other side of that, what people say is, well, if you're going to plow, who else can get $80 billion plowed into AI spend, right, for 2026? And, well, somebody who controls the votes, right? And so when you have these big turns and you need to make these big turns to get invested, well, maybe it's super important to have somebody who has that. So that's the other side of that coin. We're saying, okay, well, this is a tightly controlled company, but if we think that this vision is correct and they're investing in the right way, then maybe we support that. And so it's just something to think about. It's not right or it's not wrong. It's a share class setup. And it's just something as an investor that you have to understand and understand where they're going. And if you think that they're going in the right direction and you think that this is actually something that enables them to do that more rapidly, more efficiently than a company that was not set up that way, where you had to get more people along, then maybe that's a good thing. And so again, as an investor, as a business person, as an analyst, you got to do that work. You got to do that due diligence. And certainly we encourage our students when you're talking about the management, you're talking about, okay, well, how's the corporate governance work too? What's the CEO? How much control do they have? Making sure that we understand that when we're making decisions. And so, but look, Zuckerberg has been an excellent steward of this company, has done a great job. If you look at the metrics for the business, they continue to be innovative, founder-led company. At the Institute, we love these founder-led companies. Generally speaking, they tend to do very well. Not all the time, but many times they certainly, he's wealthy enough, one of the most wealthy people in the world, wealthy enough to obviously retire, do anything he wants, but obviously loves the business, loves the company. That's the kind of people we want running the company, especially the people. We don't want the people who make enough money and then, buy the beach house and live by the beach and pretend to be the CEO. We want people who are dedicated, who certainly have made it if their companies are already big, and really willing to be passionate about the business, really trying to grow the business, try to expand the business. We want them really thinking about the business all the time. And that's that's something that's important as an investor. When you're looking at the founder-led companies, that's a big distinction between people who are not founders and people who are founders. Now, you can have non-founders that do a great job. Tim Cook comes to mind, for example, in Apple, who has led that company into a printing press. Now, there's some challenges right now, but Tim Cook's tenure has been fantastic since Steve Jobs passed away. And so it's not only founder-led companies that we like. Obviously, Apple's a big holding. We've talked about it for the Investment Institute. But it is something that's good. Now, he can be a controversial figure, Mark Zuckerberg, back to Meta here. And so you have to decide, do you like his style? You don't like his style. Is that important to you? It's not important to you. Again, it's been a position in the portfolio. Our students have decided that, we like this management style. It suits the business. It suits Meta, and it seems to be working. All right, so what do we give management here? We're giving management, let's say, a 7.5 to 8. There is some, what do they do? In our view, let's say, it looks like they're behind on the AI side, right? The Llama seems to not be as competitive with some of the other models, but I think it's important to watch. They're still in the game for sure, and it's still an open question whether this open weight, open or closed model really, takes sort of first place, or maybe there's going to be room for everyone, and there's going to be use cases for all these pieces. And so important to watch. And so management, let's give an 8 for Zuck here. All right, moving on to the valuation. So if we look at the valuation for the company, I don't think anyone's going to be surprised about the valuation. This is a more established company, and you're talking 23 times. This is not an expensive company. The forward PE, 22 times. You're basically a market multiple at this point. And so you could even make an argument that, maybe this is underpriced. So why should an S&P 500 be priced the same as Meta and vice versa? If you have 80% gross margins and 40% net margins, maybe you should get a higher multiple. Now, people have concerns about the concentration of obviously the revenue and the advertising and who's chipping away at that. Amazon would be one of those companies chipping away at that business. And so people maybe get concerned about that, and you lower that multiple. But you're also thinking, okay, well, the growth numbers, they already have, as I talked about, the total addressable market, they already have 3 billion monthly active users. You got to get basically more people online to be users, right? And so harder to grow that TAM, total addressable market. And so, maybe they feel like they're boxed in, and the market has put a lower multiple on that. If you look at over the last 10 years, again, we talk about, put it in context, the high 101, the low 6.8, the average 36, and the median 28 here. So you're talking they're below their median. So you can make an argument that they're below undervalued in a sense relative to their own history and relative to the overall market, given where they are. But the people have concerns again about total addressable market, the growth rate on the revenue, and certainly how do you get better than the 80% gross margins to 40%? Difficult, right? Possible but difficult. And so this partly tells the story of where they are. Now, the net margins are expected to go up a little bit, so you could get a multiple expansion as related to that. But for the valuation, you're probably going to give a 7.5 or something, right? This is a pretty good valuation, maybe even an 8 for the valuation. Moving on to the balance sheet here. All right, so balance sheet. This is something, and again, if you watch the blooper reel, help you sleep at night. This is going to help you sleep at night. A ton of net cash on the balance sheet, almost 20 billion in net cash on the balance sheet, or net cash, 70 billion, and about 50 billion in debt. And so net cash, $20 billion, let's say, in net cash. That's something going to help you sleep at night, generating 52 billion in free cash flow. And if you look at the interest coverage ratio, earnings before interest and taxes over interest expense, 128 times. Again, we're all sleeping at night, sleeping like babies on Meta's balance sheet here. No problems. 10, right? That's a 10, right? We got 20 billion in net cash, and we're generating 52 billion in free cash flow. Enough free cash flow in 1 year to pay off the debt, enough debt to pay it off right now. Again, net cash position. Interest coverage ratio is super high. Not worried about this at all. And they've been responsible. Again, make sure, okay, management controls this. So how have they done over time? They've been in net cash position for the last 5 years. So it's really not, and they've been increasing the cash from 47 up to now 70 billion and they've made, the debt has increased, but they still remained in net cash, 14 billion to now 50, and so it is a different number, but the cash pile has piled up alongside it, and again, free cash flow has also grown. So not concerned. Something to watch though, right? That debt has crept up, but still huge net cash position. So something to watch, not to be concerned about. Sleeping like a baby at night. On the balance sheet, 10 out of 10 for Meta. So we pull all this stuff together. You talk about, the business, right? The business very high, 8. The management, 8. The price valuation, 8. The balance sheet, 10. Okay, you're over, like, let's say 825. You could even call this a 9. Meta scores really well with the framework. Now, you could have concerns about, where does the business go from here? Are they falling behind in the AI? That's, as analysts, our analysts are going to need to decide that. So what am I going to be paying attention to for Meta? And what do I want our students to pay attention to? The things that we need to pay attention to are what's happening on the spend on AI and where are they going and are they going to win? And do we think they're going to win? And who's chipping away at their business like Amazon on the advertising side? So we got to pay close attention to these things. Again, the capital allocation, really central as an analyst, as a business person, as an investor to understand, are they good stewards of the capital? Are they doing a good job? Are they leading the company in the right direction? When you talk about 2026, almost 80 billion, and a lot of that going to the AI, is it going to be useful? Is it going to be well spent? Is it good capital allocation decisions? We got to pay attention. There could be some acquisitions coming as well. We'll be paying attention to those. I think the AI game is super important. I think they can't forget about the legacy business, and Amazon's chipping away at that as well on the advertising side. They got to pay close attention to what's happening there and how they're integrating AI into that business. Obviously, is a big part of that. So what are we paying attention to? Capital allocation, the 80 billion, that's going to be coming out, and 67 billion this year and 80 billion next year on the capital allocation side, paying attention to where that money goes on AI spend in particular, and what's happening on the core business and who's chipping away at that Amazon, which is another holding, which we do like as well. But that's it for Meta. And again, we give them an overall score, probably 8, let's say, flat there. Great job by our analysts who picked this over the time, and we've done well with it. We'll have to do the work from here forward, though. We cannot rest on our laurels, and we will not. Our students will do a great job, I'm sure, this fall. That wraps this episode on Meta. For Market News with Rodney Lake, we'll see you back on the next episode. Thank you. Disclaimer, the content shared in the GW Investment Institute podcast is for informational and educational purposes only and should not be considered investment advice. The opinions expressed in this podcast are those of the host and guest and do not necessarily reflect the views of the GW Investment Institute or the George Washington University. Listeners should not act upon the information provided without seeking professional advice from a qualified financial advisor. Investing involves risks, including the loss of principal. The GW Investment Institute, the George Washington University, and the podcast hosts do not assume any responsibility for any investment decisions made based on the content of this podcast. Always conduct your own research and consult with a financial advisor before making any investment decisions.